If you clicked on this video, I know you love monthly dividend income. So today we are going over 3 different monthly dividend stocks. I've done 3 videos on this so far. The other 2 I will link in the description down below. Go check those out. So these are 3 new fresh dividend stocks that pay every single month that I haven't talked about quite yet. And I even threw in a bonus stock, which I haven't done a ton of investigation into, but I am genuinely curious to see if you guys have heard of it, what you think of it. So we're going to take a look. Let me know in the comments, and let's go ahead and jump right into it. The 5 metrics we are going to be looking at for our research with these stocks before we buy them. These are the ones I use when I typically go to buy a stock myself. I like doing a lot of research, especially if I'm putting in a large sum of money. So first, we're going to start with the price action. We're just going to use the chart on Google to look at the price action over the past 5, 10, 20 years, the price since the inception of the fund. This is really, really important to get an idea of where the company is versus where it has been in the past. Of course, the past isn't indicative of the future. It is nice to see what the company has been doing and how they performed in, say, financial markets that were terrible, like the 2008, 2009 housing crash. So then we're going to jump to the dividend history. Between price action and dividend history, it's easy to spot yield traps. We'll go over that. See if any of these are yield traps. I don't believe they are, but you can always double check. And then we're going to jump into the intrinsic value, see what the intrinsic value of each of these is, except the ETF, which is harder to calculate for. Then we're going to go to the drip calculator, which I love. This is a tool I've been using more recently to see how stocks compare to each other. So you can see how, say, Realty Income compares to Main Street Capital, which one would have made you more money. So those are both stocks that we use in our first 3 monthly dividend stocks video. And so the drip calculator is phenomenal. It's one of my favorite tools now. And then lastly, those pesky investor reports that no one seems to be interested in reading, but they hold all the information you need. We're going to go through, I've cherry picked some of the information I think is really useful. And so we're going to cover that. Ticker ADC. Now I'm going to try and go quickly because we have a lot to talk about, but I want to hit all the important points. 5.31 annual dividend yield, beautiful, 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 and a 74-cent quarterly dividend payout per share, which I think is phenomenal. Now, looking at the price action, it is down almost 19% just this last year, but if we jump to the 5-year, we see it was down about 18% the last 5 years. So the price action has come down quite a bit from where it was at a high of almost $80 down to $55. Now, to me, this chart looks relatively similar to Realty Income, and ADC is very similar to Realty Income, but there are some things that are different because they both started around the same time, the early 1990s, but we've seen a crazy outperformance by Realty Income, and ADC has been moving along. It hasn't been as phenomenal, but still, it's one that I think people should look at for some diversification in the REIT sector. We see this recent pullback because all REITs have been pulling back because of the interest rate hikes. And so I think a pullback was due after this insane run from the crash of 2009, 2010, and boom. So it did run up over 300%, almost 400% during that time, and that has since then trailed off, down almost 30%. This is a really, really interesting one. It really does remind me a lot of Realty Income, but there's more to it. Let's check out that dividend history. I have to jump into Seeking Alpha to check out the dividend history. It's one of my favorite tools to use. So we can see down here, the 10-year chart on ADC when they made their switch from the quarterly dividends to monthly dividends. That's why this is not a cut in the overall price. This is just a cut in when they were paying it out. So they went from paying 62 cents each quarter to 21 cents every month, and boom, you have a monthly paying dividend stock. So I'm not sure if that messes up the consecutive years of dividend growth or not, because we can see it's continued to grow since that point. But they've only had 4 years of consecutive dividend payments, although they still were pretty consecutive prior to this. And so long term, they have not had a cut since the 2010 era where the market was going crazy, especially when it comes to REITs. But I don't love that they did have to cut it back then. Trailing down, we can see how much they're paying out every month, 24 cents for every share you own. Really, really great. In my opinion, I love getting monthly income. You guys know that about me. Let's jump into some of the stats. We'll use their dividend scorecard. Payout ratio when it comes to REITs is tricky, but they have it about 74.7%. That yield, forward operating yield of 5.2, and 5-year growth rate of 6.35. That is really, really important because that's an extreme growth rate. And so I want to look at the dividend growth trademarks for the last 10 years, 6%, 5 years, 6.3, and 3-year, 1.3. So This is what we would expect because over the last couple of months to years with interest rates, we're going to see less dividend growth because they have less money to pay out to shareholders because rates are costing them more money. But before that, their dividend growth rate was absolutely insane. So there are some important metrics. You can check out dividend safety and all this on Seeking Alpha. Take it as you will. It's not always factual information. It's what their data gives them, but that doesn't always mean everything. But all in all, a solid dividend history from ticker ADC. Jumping into the intrinsic value calculator by Alpha Spread, we can see they value ADC as the best case scenario, it hitting $67.36. And right now the price is $55.87, so it's undervalued by roughly 17%. Now, you can't always use undervalue as a reason or overvalue. If you look at a stock like Tesla, it has been overvalued for the last near decade, I want to say, and it has continued to trail higher. So looking at the worst case, they're saying it's going to be a little bit less than it is currently, and best case, $82, which is wild, an undervaluation of 32% from its current price. So I like to range in the middle. I think it could go up to the 60s, but of course, I'm not a financial analyst. I do not know that for a fact. If you guys have never used Alpha Spread, this is my first time using it. I do like it quite a bit. They give you a lot of information, and you can scroll down. You can see a lot of their revenue, operating cash flow. So their operating cash flow has come down a little bit from the prior years, but nothing too scary. And then, of course, their revenue and their anticipated revenue, which is looking very, very nice. Their net income has been growing. Their financing cash flow, a little bit lower, but still, it's dropped by about 2% compared to their previous year. And then you have their balance sheet. So we're going to go over this in the investor report as well. But I do like looking at the just this overall spread of all the things you might want to look at. There's so much information on here. Their ROIC is about 4%. That's return on invested capital or invested cash. And so basically how much money you are making on just the cash that you are putting in and their averages over the last couple of years. So tons of information on here. You can see free cash flow. There's honestly so much information and profitability scores and whatnot. So they range average in their profitability score, positive gross profit, net positive income, and then they even give you some targets on the forecast. So they are forecasting it to be much higher than it is currently. From what I was reading, they're averaging around $66, $67 is what people are expecting it to get to. I don't know if it's undervalued now just because of rates, but again, you never want to just base everything off of what analysts are saying. Do your research, go with your gut, learn from your mistakes, and keep moving on. So I have plugged everything into our drip calculator. It's a little bit funky looking, but let me explain. So we have ADC in black, SPY in blue. I always like comparing to SPY because everyone always says just put all your money in SPY, in the NASDAQ, and you'll be fine. But I want to see how these companies do in comparison to these indices, to these big funds that everyone says just to buy in the broad market fund. So if we're looking at ADC, so if we had invested $10,000 way back when in 1995, if we had invested $10,000 in ADC and we had invested it in SPY, you would have an average total return with dividends reinvested, which is really, really important, with ADC of 11.97%, while SPY is 9.85% average. Now, it is pretty close, but over a long spread, like almost 30 years, you start to see a huge difference. Your ending investment after $10,000 and 29 years is $254,000, almost $255,000. Then when you look at SPY, still a phenomenal return of $147,420. So overall, your total percentage return for ADC is 2,500%, whereas SPY's is 1,400%. Still both, again, phenomenal returns, but ADC has outperformed, which is important to note. Now, with dividends not reinvested, let's talk about this and what this means. So if you have dividends reinvested, what that means is every time a company declares a dividend and that money hits your account auto reinvests it into the same fund that gave the dividend out. And it does that no matter what time, no matter what day. Of course, the market has to be open, but it does that no matter what the price is. So you can immediately just, you buy something. It's a really good way to dollar cost average over time, in my opinion, because you have no say in it. It auto does it. I love it because I don't have to go in and fill everything out, put in all the information and click buy. But it's not for everybody, especially if you're not looking, say if you're retired and you're looking for monthly income, then you wouldn't want to do that. but it is really something that a tool that I like to use and I think is really, really important. So we can see without dividends reinvested, you still have a great return. You still get a average return of 7% with ADC and 8.62% with SPY. So without dividends reinvested, SPY does reign supreme, and by quite a bit. You end with 70,000 for ADC and over 106, almost 107,000 with SPY. So when it comes to these dividends, I'm telling you, key is to reinvest those dividends and make more money off your dividends. Buy dividend stocks that you like and trust. And you can go wrong, but in the end, it's all what you want to do. So what we're going to do now is we're going to jump into our next section. So I have pulled up Agree Realty's. This is just their investor report, something that everyone can go in, check it out, read what you want to read, find out information. We're going to click through some of these slides and talk about what they're doing. So they have their overview, consistency. It's like a PowerPoint. It's like a really fancy PowerPoint that basically has a bunch of numbers and tells you all this information about the company. And so if you guys haven't looked at these, I really think that you should. For those of you that don't know, ADC, they do retail. Rethink Retail is like their campaign slogan. It's what they talk about. So they have a lot of these companies, Boot Barn, Burlington, Gerber, tons of these companies, and you can just click through and find all this information for free. It's literally for free. They give this out. They want people to buy their stock and own their stock. So we can see a ton of and this is just their investment foresight. It is what they have been doing, their acquisitions over 100 locations since 2013, which is pretty wild. And TSCO is their second largest tenant, which is, I'm assuming that's Tractor Supply Company. And so, yeah, they continue to purchase these and the stock price continues to perform well. You can there's so much information here, guys. I'm not going to, kind of bore you with a lot of it. I do think it is important to be able to read through and understand this stuff, like I said, but let's go to the portfolio. I love looking at portfolios. We can see that retail is 69%. There's no way they did that on purpose, right? 69% total, 69% investment grade, and then they have 16% sub investment grade. And so what this means is they have so much money in retail. We can see a lot of everyone's favorite places: Costco, Walmart, TJ Maxx, Target, Chick-fil-A, Dollar Generals are everywhere. I can't seem to escape them. 15% not rated. So I would assume investment grade is the higher report, and sub-investment grade is a little bit lower, but still they have a lot of investment grade properties and then some sub-investment grade properties. Starbucks, how did I miss Starbucks? Best Buy, Home Depot, Amazon, pretty phenomenal. And then you can look more into their regional retailers, franchises, all this kind of stuff. So all this information, like I said, totally free. We can see their top ground tenants: Lowe's, Walmart, Home Depot. We've seen a lot of these, Bank of America. So much information, and they're going to talk more about all this stuff. So if you're really looking into buying one of these companies, I really think that you guys should read through all of these. And we can see that they reviewed over $82 billion of opportunities since 2018. So they are looking over and over and over. They are trying to find new places, better markets, better areas that are for growth and stuff like that. So total, their growth, 164,000 net lease opportunities and growing with best-in-class retailers. So like I said, there's just more of who they have: electronics, quick service restaurants, fast food places, merchandise, grocery stores, all this stuff. So tons of information on here. Go check this out. But now let's talk about the ETF of the group. Let's jump straight into it. When I was doing my due diligence to find the best monthly dividend stocks to talk about, I couldn't believe I overlooked ticker SPYI, the NEOS S&P 500 High Income ETF, and that is what it is. It generates an insane amount of monthly income. Now, the reason I even found this one is because I put it in the $1,000 dividend account challenge, where I'm trying to make as much money through dividend investing in 2024 to see how viable it is, and SPYI has been one of the most consistent earners. The price action has been great. We can see over the last year, it's up almost 7.5% roughly, and the last 5 years, 3.19, which is actually since inception, because it started in 2022 on September 2nd, which is actually my birthday. So this is one of my favorites for that reason as well. But it does pay out an insane dividend of almost 12%. It ranges depending on the price of that day, but it ranges from about 11.5% to 12.2%. I recently did a video on SPYI in the how many shares to see how much money you would need to make. I think it's $500 every single month, and the amount you'd need to put into this is significantly lower than a lot of the other stocks I've done in that series. So it was a very, very fun video. You guys can go check that out on my how many shares playlist. But honestly, this one has just been one of my favorites. It's been the best performer in the dividend account when it comes to consistent dividends, and I just don't have a lot of complaints about it. So let's take a look at the dividend history. Because it is such a new fund, we can see that it has not been paying out for 10, 20 years. It's been paying out for a little over a year. And when it comes to ETFs, if you guys don't know this, the dividend income is inconsistent. So these are not just dividend cuts every time. These covered call ETFs, anything having to do with options and when they're making money off premiums, it all depends on how the market performs, how much money the payout is going to be, and how the options call expire. So you may end up with some months having more dividend income and some months having less. In the video where I talk about SPYI, I actually compare it to JEPI, a really popular JP Morgan fund, and JP Morgan's funds range pretty drastically, like a 50% swing. At one point, they were paying 60 cents a month in dividends. At one point, they were paying as low as like 27, 26 cents, which is a really big swing if you're using this for monthly income. So that's why I think so far, SPYI has been just phenomenal. They've been consistent with their lowest payment being what? I see 46, around 46, and their highest being around 50. So really, really consistent so far over a little over a year, almost a year and a half, which I like to see. So if you're just banking on this money coming into your account every single month, then this is one of the ETFs that I think is the most valuable to you. When we look at their dividend scorecard, all of this is going to be very different than what we've been looking at because of the fact that it's an ETF and not something like a REIT where the financials are all different. But we can see the yield here of 11.7%. Annual payout is almost $6 and monthly payments, which I love, love, love. Their dividend growth, of course, is going to be weird because of the fact that it is an ETF and the yield and safety and all that can be a little bit funky, but still really good to check out all this information. Let's go ahead and jump into the next section. Pulling up SPYI versus SPY in the drip calculator. Now it's not on the intrinsic value calculator because it is so new, and I'm not sure if they even put ETFs on those, but we can see that SPY has definitely outperformed. If you look at the average total return, you get 12.44% with SPYI versus 19.8% with SPY. Now, normally, I would say, yeah, SPY is just better, but the thing is that SPY has just been on a tear lately, and SPYI is so new that they only have data from August of 2022. If you had data 5 years ago for both, I think it would be a different story, but still a good return for both. You're averaging 12% and 20% in a year and a half. So that is what I like to see. If you're not reinvesting dividends, you drop down a little bit for both, but still a pretty decent drip calculation. I'm curious to see what this one's going to look like in 5 to 10 years with drip calculator, but only time will tell. After looking around on the website for NEOS, which is the company that runs the S&P 500 High Income ETF or SPYI, we can see their fact sheet. So when it comes to these ETFs, it's very different how they lay stuff out. It's not like what you're going to see with the BDC or with the REIT. They're not going to have all these holdings that they have as in like physical properties, and with BDCs, companies they're invested in. It's very, very different how they do things. It's all about where their money is in the market. And to be honest, it's complicated. In my opinion, it's overly complicated for what I like to explain. So we just have the fact sheet pulled up. It gives you the basics. They do have a higher expense ratio of 0.7%, which I don't love, but because it is an actively managed fund, it performs better than typical passively managed funds. And so that's what this sheet is saying. It talks about their top 10 holdings and how they're subject to change. We see Microsoft, Google, Nvidia, Amazon, Meta, Google, another Google, Berkshire Hathaway, all these. And then we see one of the things that I mentioned in the last video on SPYI is that it seeks high monthly income from their key features here, which we know you kind of get a nice return on price as well as a good return with the dividends, tax efficient option strategies, and ETF structure. I forgot to mention this one. The way they run these dividends, it's optimized. I'm not going to get into all the nuances of it because it is really complicated, but basically you're normally taxed at a pretty high rate on dividends because they're short-term gains. And the way SPYI functions with their dividends, you're taxed less, which is really, really nice. It just puts more money in your pocket at the end of the day. And then you also have potential upside equity participation, excuse me, because this is why it's different than the normal QYLD, XYLD, the funds that I really don't like, to be honest. I used to like them. I don't love them anymore. I know there's a huge fan base for QYLD, but when I held it, it ended up negative for me, even with dividends reinvested. So I wasn't a big fan of that. And our final of the 3 monthly yielding dividend stocks, GAIN, Gladstone Investment Corporation. So in part 1, we talked about, I think it's GOOD. They're the BDC version of the Gladstone company that actually had a higher yield but was much higher risk. Now, GAIN has just been performing so well. It has a near 7% dividend yield and a 7.01 PE ratio, which is beautiful. They're up almost 10% in the last year, 20% in the last 5 years, a little bit low, but that dividend yield has definitely been working wonders. And they're down 7.5% all time. Now, we can see that they had a really bad drop in 2009. This was definitely with the crisis going on in the housing market, in the real estate market. And since then, they trailed all the way up to where they're up 300%. And they've fallen 17% since then. So the chart isn't great, but it's not super ugly to me either. I think that there is definitely some potential here, but we have to check out this dividend history. Right off the bat, this might be one of the ugliest dividend histories I've ever seen. And I don't mean that in just the price, but these special dividends are insane. We can see that GAIN paid a special dividend of 88 cents in December of 2023. So pretty recently, which is wild. And then since then, it's just been paying the 8 cents per month. So falling back, we can see, there's so many special dividends. 1, 2, 3, 4 special dividends last year. 3 special dividends the year before, none so far. I'm going to have to get some of this company. I'm not telling you guys to buy this, but this is just, I love special dividends. Main Street Capital from the first video had so many special dividends as well, and they just make my day. All of a sudden you just got this nice chunk of extra money, and boom, there you go. So tracing back, they've been jumping their dividend a little bit over the last 2 years from 0.075 up to 0.08. And it looks like they haven't cut it. So it says they only have 2 years of consecutive dividends. I'm not sure. It looks like they did. No, it's another special dividend. So it's probably something with Seeking Alpha, but I think their dividend is pretty solid. If we look at their scorecard, it's almost 7% yield. Dividend payout ratio is 124.7%. But like we said, when it comes to a lot of things, payout ratio gets messed up. And so that is definitely important to note, especially when it comes to these companies, REITs especially. So dividend growth, let's check this out. So down, let's see, 3-year compound annual growth rate is 1%. 5-year is 9.75, which is remarkable. They've been growing that like crazy. And the 1 year they have it at 5.5, which is beautiful. Dividend safety, they don't give it a rating. There's tons of other facts on Seeking Alpha. I kind of jump through and just look at what I want, to be honest. I definitely cherry pick. But all in all, a decent dividend history, and those special dividends make this just beautiful. All right, the intrinsic value of GAIN, Gladstone Investment Corp. This is a BDC. The worst case undervaluation of 7%. Base case or middle is undervaluation of 20%, and the best case is undervalue of 36%. So looking at the base case, they're expecting, so the average analyst is predicting they're going to hit 17.5 US dollars, and right now they're at about just under 14. So again, ton of good information on this Alpha Spread website. We can see that they have resulted in a potential profit of 93% over the past 5 years, which is great. Total of 6 transactions because they are BDCs. That's what they're buying. I love this little chart telling you when to buy and sell. Honestly, I would never do it. But look, buy here, sell here, profit 22%. Buy. They just put a buyout at $14.96, and what is it at now? $14.96, and it's currently at $13.96. So it even fell a little bit from where it is. I like this. I don't know if it's gonna work long term, but wow. Curious to see how that works. You can go through, read all this information, their cash flow. One thing I do want to point out is they had really good return on invested capital and return on capital employed compared to Agree Realty because they're just doing good. They have been doing good, especially these past couple of years. We can see on the 10 years, 7%, 5 years, 8%. So some good information here. Let's jump into the DRIP calculator and see how they've been performing. So a very, very interesting DRIP calculation. I'm really surprised by this because they had better financials in the recent years compared to Agree Realty, but they lost to SPY by about 70% with dividends reinvested from 2005 to the current. From $10,000, you would get $53,000 with gain, and with SPY you'd get about 60,000, almost 61,000. And then without dividends reinvested, it's not even a competition. You have to do dividends reinvested when it comes to these kind of companies. As we can see, they've just been, it's not even half. So less than 4% return compared to a 9% return with the drip calculation. So all in all, definitely makes me rethink. I thought this one was a home run right off the bat, but it just goes to show you never really know. They have picked it up in the last couple of years, and that's why they're following pretty closely to SPY, but they're still not performing as good as SPY or as good as Agree Realty. So it is something to think about, even though now they have a higher yield. Let me know what you think about this in the comments. Looking at Gladstone Investment, their website, it is a little bit messy, I'll be honest with you, but this is just their current investment map, which I do think is cool. It's a nice addition to a website. It shows that they're all over the place, but what we really want to see is the overview. Let's check the overview for their financials. This is how you get to everything. Investor presentation from December 31, 2023. Oh man, a lot of words. So I have looked through this a little bit. I wanted to show you guys exactly how to get to it, but there is still a very interesting, just some interesting information here. As we can see, versus their industry peers, this is a really important part. Long-term historical performance compared to industry peers in total return of equity. So gain with 1, 3, and 5 year total returns, 31, 97, and 154 compared to the industry of 28. So they're up by 3, 59. So they're up significantly by 40 something, 38. And then 86, where they're up almost double. So they really have done really, really well in outperforming just the sector average. Of outperforming their peers. And that is interesting because I did talk about some other high yielding dividend stocks in our last one, like HRZN, which is a BDC, Main Street Capital, which is a BDC. So there are some BDCs that just do extremely, extremely well. And so we can continue to look through a lot of this long-term horizons, what they're going for. We can see that first secured lien debt. This is really, really important. Second secured lien debt, 15%, not bad, and preferred and common equity. So the difference between first and second, basically first is better because if the company goes under, first lien, you're paid out first compared to other investors or other, capital where the money has to go to, where second lien, you're just not as high on the totem pole. So you definitely, just something to think about. It's not a huge spread between these two, so I think that's fine. 15% on second, a secured second is definitely not bad. Annual portfolio growth rate of 7.4%. So pretty nice. This is really, really, really interesting. So portfolio growth rate is number of properties or number of money, amount of money that they do have in properties, and that is growing up, which you do like to see because if they have more money, they can make more money for all of us. Something that I do like to note, net asset value, annual growth rate, this is just the overall value of what they have and how it is increasing. So I do like to see that. So the investment portfolio at fair value versus net asset value, both continuing to trend up quite a bit. It's a little bit harder to see, bouncing around a little bit, but overall some really good growth between fiscal year or Q3 of fiscal year 2024 versus 2023. And then again, guys, there's just more total investment income, annual growth rate, tons of info. I actually do like looking at the numbers, the debt versus equity. This has got to be in millions. Yep, in millions, says that right up there. And boom, just, total versus debt versus equity with their invested capital, pretty good. More of their diversification. We already looked at some of this, and boom. Now we're going to jump into the final bonus stock that I want you guys to take a look at. Let me know what you think in the comments. Let's check that one out. In today's bonus stock, ticker LNC, Lincoln National Corp, with a 6.62% dividend yield, founded in 1905. It's one of the oldest insurance companies. They have a number of subsidiary companies that they run all their businesses through, and basically it's complicated, but there's a lot that goes into this company. Again, I haven't done a ton of research into this. I don't even know if it's one that I'd like to buy, but I do think it's a different sector than what I'm used to purchasing, and I do want to check out how the dividend has been performing and see what the intrinsic value calculator says. Oh man, their dividend history is wild. They went from paying 42 cents, cut it to 21 cents, and then boom, all the way down to what even is this? Is that 1 cent? And they built it all the way back up to 45 cents. But this is definitely higher risk. They do pay quarterly, but man, they've had some crazy dividend growth though. Look at this. Compound annual growth rate, 10 years of 13.22%, 6% over the last 5 years, 3.5% over the last 3, and 1.2 But the intrinsic value calculator is insane. Check this out. The intrinsic value calculator shows, one, that they are a possible value trap, which I think is really, really interesting. I will need to look into that. They may be losing money really, really poorly. We can see worst case says that they're undervalued 63%. Base case, middle case is 72% undervalued, and best case 82% undervalued, which is actually insane. Their buy sell said that you should have bought it a long time ago at $54. Currently, what's it trading at now? $27. It has trailed down horribly, but there could be a case for some bounce back potential. I got to do more research into this and see if this thing is actually going to be worth it in the end. Let me know what you guys think. Is this one a yes or a no? And comment your favorite monthly dividend stock, and let me know if you want to see more videos like this one by clicking the like button and maybe subscribing if you found value. Of course, I hope you guys did, and I will see you in the next one.